Here's part 6 of our Chapter 3 video lecture where we're covering the taxability of Social Security benefits. The general rule is that Social Security benefits are non-taxable. But for taxpayers that have moderate or high income, then part of the Social Security benefits, or maybe most of it, will be taxable. Here's the form that the government will send out to tell the taxpayer how much benefits they've received. That would be here in box number 5. Make sure if you're given the form, watch for box 6 for any income taxes that were withheld. That's federal income tax. Social Security benefits are never taxable for state, here for state of Hawaii. Other states may tax Social Security. And this big column here may show any type of withholding, like for Medicare insurance, and any adjustments that were made. Okay, so we're interested really in this box here and how much of it's taxable. Our textbook really doesn't go into the actual rule regarding how to calculate the amount that's taxable. It goes straight into examples, but let me see if I can kind of give you the rule. What you're going to do is take a look at the taxpayer's adjusted gross income. Remember, that's a specific line on the 1040 form, and that's going to be before we calculate any taxable Social Security and possibly not consider some adjustment deductions. So this is not really the true AGI, but it's pretty close. And then to that, we're going to add 50% of the taxpayer's Social Security benefits to get some type of revised AGI. Yeah, I'll just put AGI again over here. So we're going to compare this tentative AGI to a dollar limit. So in the case of a single person, if that total is under, let's say, 25,000, then any Social Security benefits received by that single or unmarried taxpayer is tax-free. But once this number here goes over 25,000, then part of, or the excess will be 50% taxable. In other words, now you're going to include that amount into the income. And then if you add another, looks like another 9,000, or if the total of, again, this amount exceeds 34,000, then the taxable amount excess is going to be 85%. Again, if it's under 25, the amount that's taxable is 0. If it's over 25,000, the amount that's taxable is up to 50%. If that revised AGI is above 34,000, the excess is 85% taxable. And this is for the single filing status. If you're doing married filing joint, then the range kind of moves upwards. I believe it starts at 32. So if your revised AGI is under 32, none of the Social Security benefits are taxable. If you go over 32, then 50% is taxable. If you go over, I think it's 44,000. Again, we're looking at this number here. It goes over 44,000. Then the excess is taxed at 85%. So our textbook goes through these examples here. Yeah, but I'm not going to go through detail. When you need to calculate the amount that's taxable, what I want you to do is to use the worksheet that's in the instructions to the 1040 form. Here on page 20, begins on page 28, where you would enter the total amount you receive for Social Security benefits during the year, again coming from that SSA 1099 form. And we're told to take 50% of that. And all of these numbers here are basically saying add in the adjusted gross income before any taxable Social Security. They give you the specific lines here. And it does include line 5 because that's what we're trying to calculate here, the amount of taxable Social Security. And then you're going to add in also this line 2A. That's called tax exempt interest, which is a topic going to be covered in our next video, really tax-free interest, but it's added in for purposes of calculating how much Social Security is taxable. Then you're going to subtract out deductions on Schedule 1. Remember, we call those adjustments. And we'll learn more about those in the next chapter, chapter 4. But they're not subtracting all of them. One of the ones they don't subtract out is a student loan interest deduction. And then you get your answer, and we're going to combine it to those amounts I mentioned, yeah, the 32 or the 25 based upon the filing status. And if you exceed that, the excess Social Security may be taxable. And again, you compare that really to half of this. And then if your income goes over the higher limit, yeah, the higher limit would be 9,000 more or 12,000 more for that revised AGI, then you start hitting into the 85% rate. So if you know the taxpayer's income is high, like maybe 50,000 or 60,000 for a single person or 80,000 for married filing joint, you probably can assume all of the Social Security benefits, at least about 85% of the Social Security benefits is going to be taxable. So you'll be using this worksheet, yeah, if you're doing the return manually. But if you're using tax software, all of these calculations are going to be done for us automatically. Assume if all the other income and deductions are already filled in. Yeah. Okay, I think that's all we want to cover. Well, let's take a look at the 1040 form. So here in line 5A would be the total Social Security benefits received during the year. If you have a married filing joint couple, that will be the total of both, yeah, of the taxpayers. And then what's calculated as taxable on that worksheet would be put here in line 5B, added to the other income to get the total income. At most, this 5B would be 85% of this 5A. Again, that's usually for higher income taxpayers. If you're below that dollar limit, again, that was the 25 or the 32 for your revised AGI, the taxable amount would be 0. And like we've seen for most tax returns, we just would leave the field blank, yeah? And if it's 0 over here, if it's blank, you should leave this 5A blank also, even though the taxpayer had received Social Security benefits during the year. You only fill in this 5A if you're putting in a dollar amount here in 5B. And again, you got to do this on the worksheet, yeah, the calculation. And you would do it for combining it for both the taxpayer and spouse in one calculation and not separately. Okay, go ahead and take a look at the next video where we're going to talk about interest income back here in line 2.